Hey everyone, hope you're all doing well. I am going to go through the second lesson about accounting. So we are going to be looking at lecture 2. We've gone through the balance sheet. We've defined what are assets, the current asset, the non-current. We've looked at the liabilities, the current and the non-current. I hope everyone still remembers those. Okay, let's get to today's class. So we are going to look at what goes to an income statement. An income statement represents a company's revenue, expenses, gains, losses, and the net income for a specific period of time, such as sometimes a quarter, but mostly just a year. We do have income statement for month to month, we do have for quarterly, but usually we just do it for a year or a month, depending on what exactly you are trying to get across and who is requiring this particular information. So what goes into an income statement? We have total sales, how much did you make? Gross profit, operating expenses, net income before taxes, and then the net income also after the taxes. How much are you paying in terms of the tax that you need to pay to the government? So let's look into the gross profit. When we're looking into gross profit, we want to know how to actually calculate a gross profit. You know that when you have a salary, this is an example, you do have the money that you receive before you pay all the other deductions that are actually deducted from your income. It could be medical aid, it could be insurance, or any other thing that you need to have deducted from your income. So when you're looking at the gross profit, looking specifically into a business, we're looking at the sales minus the cost of sales. Then we get our gross profit. So in which department would you get cost of sales? It is F&B. Why is that the case? Why can't you find the cost of sales when it comes to rooms and services, rooms and division? Because you cannot sell a room. You cannot sell a room, but when it comes to food, you can sell food and you can quantify how much it would cost. So in F&B, because food and beverages can be consumed, whereas rooms cannot be consumed. So when you're calculating gross profit, we're looking at sales minus the cost of sales. Okay, then we are going to look into, these are just definition, perpetual versus periodic inventory. How does this system work and how do we calculate cost of sales when you're using each of these methods? We have perpetual, we have a periodic inventory system. How do we calculate this and how do we use the cost of sales for each of this? We need to be focusing specifically for this module on the periodic for bookkeeping purposes. We are going to focus specifically on the the periodic, sorry, for bookkeeping purposes. So what are we going to be looking at? When we're calculating the cost of sales using a periodic method, we say opening inventory plus purchases plus carriage on purchases minus staff mills plus issues to this department minus issues to another department minus the closing inventory. It will make sense once you start making a lot of example, making use of examples, but I want you to now just take note of this. This is the set standard that we use in order for you to calculate the cost of sales using a periodic method. You will see as we make more examples on how that will come into play. If you use lemons, let's say you have lemons and then you take them from the kitchen to use them in the bar, you do record it as it has been reduced from the kitchen and it has been added to the bar because you took them away from where it was originally bought for. We bought them for the kitchen, probably to use in the restaurant, but we realized that in the bar we need it for cocktails more, and there's not a lot of people that uses this lemon. So what do we do instead of going to buy a new bag of lemons? We remove them from our restaurant and then we add it to the beverages cost. So it's important that you record almost everything that happens in the organization so that we know exactly where was this used. Okay. Types of revenue, as I said, mostly it's just going to be definitions. We're looking at the sales, you're looking at the interest received. We have defined some of these things. We're looking at other incomes, at different streams of income that a particular business can have. An example, if you are running a hotel, or you do have an Airbnb that is big enough, you can have conferences. You can get some of your revenue from a bar. You can get some of the revenue from the restaurant that you currently are running. So there's so many ways in which you can generate income specifically in hospitality. So it's all about knowing exactly what works for you and how much space you have in order for you to generate as much as possible. Okay, so this is like, what are the other types of income or other examples of income that you can think of? Please think of examples so that when I see you next time, you can be able to engage on those. Which department generate the sales in the hotel? You need to know that. Where exactly is your money coming from? Is it coming from rooms? Is it coming from the restaurant? Is it coming from the bar? Is it coming from conferences? You need to know exactly which department is generating sales in a hotel. You're looking at the interest that is received. If you are generating income from these other avenues, do you receive interest on these? Is there a way that you can receive interest on some of the facilities that you have? So it's important to know all of that. What are the type of expenses that a business in hospitality that can possibly incur? We're looking at the cost of sales. If you are going to sell something, there are costs that are associated with that particular item. An example, if you are selling a plate, there are costs that were associated with you actually getting that plate. You needed to get labor, you needed to pay for electricity, you needed to pay for water, you needed to get the ingredients. What are the costs that are associated with the sale that you made? Some of the expenses are departmental. Some of the expenses only just affect rooms division and does not affect mainly the restaurant. So, of food and beverages, what is it that affects each and every department and how do we record those? So, it's important to know what are the things that are departmental and those that affect the whole organization. You look at the overhead, we're looking at income tax, we're looking at depreciation. Already by this time, you should know what depreciation is. It's a decrease in value of a particular item. It could be a vehicle, it could be anything that probably would lose value over time. What are the two methods that can be used to calculate depreciation? We are going to go a little bit in detail on how to calculate depreciation. Why is it important for you to know about depreciation? Depreciation, as I have explained, is a decrease in value of a particular item that you have purchased. Usually it's an asset. It starts as an asset and then it depreciates in value. Or sometimes it was an expense from the beginning and it just eventually depreciates in value. So it's important for you to know this because once you buy an item, and it loses value, you can never sell it at an original price. So when you are in business, it's important to know exactly what items or what do you have in your business that will probably increase in value, appreciate, or those that will depreciate eventually. I hope everyone still is understanding. If you do not, you're more than welcome to engage on the chat. So what is depreciation? Depreciation, the definition is a reduction in value of an asset over time due in a particular wear or tear, due to wear and tear. Other important terminology that you need to take note: accumulated depreciation. If you have accumulated a certain amount of value or you have decreased that particular item with probably 10,000 each and every year, then if I ask you in the next coming 3 years, how much will have depreciated? Obviously, you need to multiply that by 3. That sounds easy to say it's 10,000 in each and every year, it would depreciate with the same 10,000. You will see that at times it's easy like that, and at times you need to calculate further, and you will see the difference in those two methods. So we're going to also look at what is a book value, the carrying value. What was the book value of that particular item? You look at the two method of calculating depreciation. As I said, we will look into how to calculate depreciation and which one is better at times and which one most of the organizations they prefer. So we have a straight line method and we have a diminishing balance method when it comes to calculating depreciation. A straight line and a diminishing balance. So what is a straight line method? Like it says, it's just straight to the point. So here the asset is depreciated by the same amount for each and every year. An example, if I buy a vehicle and I tell you that each and every year this particular vehicle is going to depreciate with 10,000. So year 1 is 10,000, year 2 is 10,000, year 3 is 10,000, year 4 is 10,000. So it is a straight line method. It is the same amount each and every year. But if the amount changes, then we have a diminishing method. Let's look into the straight line method. An example, an asset costs 300,000, the price. It depreciates 10% per annum on a straight line method. So if I ask you, calculate the depreciation then of this particular item, then you will say 300,000, of which is the original price multiplied by 10,000 to get that it depreciate at 30,000 rand. But because we're using a straight line method, it means for each and every year, this particular item will be losing value of 30,000 each and every year. Okay, let me repeat that. You have an asset that you bought for 300,000, and then they say it depreciate at 10% per annum on a straight line method, calculated depreciation. Then the depreciation will be the 300,000 multiplied by 10%, which gives you 30,000. It means that each and every year, this particular asset will depreciate at 30,000. Therefore, you need to take that into account for as long as that particular asset is with you. Then eventually, obviously, it will reach a point where it does not have as much value. So you cannot sell it to another person with maybe 100,000 because it would have depreciated. What is the difference then between a straight line and a diminishing balance method? Assume the assumption that we have is that the fixed asset loses proportionally more value in the beginning of its life than at the end. So here it changes each and every year. Unlike the straight line where we had the same amount depreciating each and every year, when it comes to the diminishing balance method, it changes. Let's look into an example. We have an asset that costs 300,000 and the depreciation is 10% per annum on a diminishing balance. So how do we calculate then the depreciation? If they say at the end of year 1, what will be the depreciation? You will take 300,000 multiplied by 10% to find a 30,000 rand. So this is for year 1. This is what the depreciation is. It's almost the same as a straight line. But then things start to change when we have now year 2. Because now the book value of this particular item is no longer 300,000. We take the 300,000 and we minus the depreciation that you have lost, or the value of that item that you have lost, to get the 270. So the new book value now from the beginning of year 2 is 270. And then in order for you to get the depreciation, or what is the value that will be lost, it will be the 10% of the book value, the new book value. So it will be 270 multiplied by 10%, which will then give you a 27,000. So you see, each and every year it changes, it depreciates, it decreases. So this is a diminishing balance method. The straight line, each and every year, it will be exactly the same. But then when it comes to the diminishing balance, it changes because the book value will change. We had the 300,000 multiplied by 10, you got the 30,000. And then now the book value, it's 300,000. You minus the 30,000 to see exactly at the beginning of the year, what am I working with at the beginning of year 2? And then you take the 10% of that new book value in order for you to be able to get the new depreciation. So what will be then the depreciation? It will be 27,000. And then if I ask you, what is the book value at the end of the year? The book value is 243 because you would have taken the 300,000 minus the 57. Where did you get the 57 now? It's the 30 minus the 27 in order for you to get the 243. Or you can just say the 27 minus this, and then you can get your answer. I hope you're still understanding. I'm just going to give you a minute to take this all in. Please just let me know if you are not understanding on the chat, or send me an email. I am available for you to actually assist. I'm available to assist if you are not sure of what is happening. So if you do say indeed 270 minus 27, you will get a 243,000. Okay. Then we have a workshop that I want you to look into, an activity. I purchased a vehicle of 200,000 and it depreciates at 20% per annum. What is the total depreciation after 2 years using a straight line method? And then the second one, diminishing balance. Stop, pause this video and see if you can be able to answer this. Question number 2. I purchased a washing machine for 20,000 Rand on the 1st of March 2011. What will be the depreciation at the end of 2011? B, if the machine is depreciated at 15% per annum using a straight line method. So what is important is knowing which method is being used. Please take a moment and see if you can be able to answer this, and then we can be able to look through the answers. I purchased a vehicle of 20,000 and it depreciated at 20% per annum. What is the total depreciation after 2 years using a straight line and a diminishing balance method? You should be able to know that at this particular point, the end of the year for the straight line method is always going to be the same as any other year because we are using the straight line method, and the depreciation will be the same. And then diminishing, end of the first year, it's 20%. You get the same amount as the straight line. It only starts changing from year 2 because the book value has changed. And then from there onward, you will be able to calculate what will be the depreciation. The question was not what is the book value. The question is what is the depreciation after year 2? How much has this particular item depreciated by? At this point, year 1, it was 40, and then plus 40 gave you 80. And then year 2, it has depreciated with 40,000 the first year, and the second year it depreciated by 32, which eventually gives you a 72. Okay, I purchased a washing machine for 20,000 on the 1st of March 2011. What will be the depreciation at the end of 2011? If the machine is depreciated at 15% per annum using a straight line method. So from the beginning of March 2011 till December, how many months do you have? We have 10 months. Please just double check if you understand what that means. And then the depreciation at 15% times the 10 divided by 12, because remember, this is not for the whole year. We're looking only for that 10 month. Please always take into account that sometimes you can try and trick you. Then you will have the 2.5 and then the 10 divided by 12. Where did we get it? Because we are only accounting for the 10 months. So it's important that you are able to take note of that. So some of the questions that we can ask you is to define the term accrued. What are the 4 adjustment accounts that are only opened for a day at the end of the financial year? You need to know that. There's so many questions that we can come up with. Explain what each of them means, and then you can know what a prepaid expense is, what an accrued expense is. You already know all these terminologies. Please take note of this. And also, what is the difference between accounts payable? We've discussed this in class, and accounts receivables, and give an example or another name for each. You can also go through this, and then you will be able to get more context. What is the definition of cost of sales? And give an example or in a hotel of cost of sales. You will be able to get that cost of sales and the cost of acquiring or manufacturing a particular product. It could be a plate, it could be a drink that you're serving, those costs that were associated with that. So please go through this. You already know some of these things. Pause the video, get the questions and see if you can be able to answer some of these questions. I hope this was useful and that you did understand. If you did not, as I said, at any point you can always your questions on the chat. Thank you so much. Bye.